So my name is Larry Hatheway. I'm the chair of this last session. My job is really, I suppose, to facilitate, as everyone knows. By way of introduction, Howard Marks will be giving the first set of remarks in just a moment. We'll be playing that as a interview, I believe, with you, Patrick, that was recorded, and he will be joining us later for the Q&A session. And after that, we'll invite Dylan up for his comments as well. Okay? He will go straight after, and then we'll do the combined Q&A. Okay, so if we can start with Howard, we'll get things rolling.
Hello, Howard. Thank you, first of all, for participating in our symposium by way of this fireside interview, in which we'll discuss some of your memos as well as other reflections that you've shared with investors over the years. For the benefit of our multidisciplinary audience, I'll introduce some of these questions with some explanatory background, especially from a cognitive angle. So I'd like to start with a few questions by MMH team members. So the first one is from James Clunie. You often write about the concept of the pendulum. More recently, in a podcast, you applied it to international affairs. While this appears at first glance to be a mechanical model, importantly, you have also applied it to human psychology, especially mood swings. These fit much more with a spontaneous market mind, which you have also referred to. For example, in your memo, you can't predict, you can prepare. Consequently, the question is, in what way and or to what extent is the pendulum mechanical? For example, would it be correct to say that while the pendulum implies mean reversion, the latter is not a mechanical process and is thus difficult to predict?
Well, thanks for that question, Patrick, and I'm very pleased to be discussing these topics with you. As you know, they're something I'm fixated on, and it's great to have someone to talk with about them. I think the pendulum is a good example of many of the things we're going to discuss today. It is an idea, it's a concept. The idea is something that swings back and forth, something that oscillates, something that fluctuates around a midpoint. That's the whole concept. It is certainly not mechanical. I mean, in physics, I think the pendulum has certain qualities, and as a result, its behavior can be predicted. But in the things I'm talking about, no. As you know, my last book, 2018, was called Mastering the Market Cycle, and I talked a lot about in there about the pendulum. And I got a note from Nick Train of Linsell Train in London, and he said, I disagree with you because this is not a pendulum. The movement is not regular, it's not predictable, it moves at different, the speed varies, the extent varies. And I said, Nick, let's have lunch. So when I next got to London, we sat down for lunch, and I explained to him that there are a variety of definitions of the pendulum. And in particular, one definition says it's mechanical and thus predictable and governed by the laws of physics. And another definition says that it is a swing. In your notes to me, you used the term a mood swing. And I think that understanding it as a mood swing is much more useful for our purposes. As this discussion progresses this morning, I think the main thrust is going to be that these things are not scientific and thus consistent and repeatable.
Okay. Russell Napier, another member, has a related question, also covering the mechanical angle. Mainstream economics, also known as mechanical economics, which partners the unlikely bedfellows of neoclassical and neo-Keynesian economics, views and treats the market as some automaton, in a way, to centrally engineer, plan, and steer. If instead we view the market as, which obviously is our thesis, as embodying our collective extended mind, acknowledging its warts and all, which two episodes in your career would be best suited to study the market mind?
Well, Russell's question in your last sentence about the two episodes would limit me too much. So if you don't mind, I'm going to go way beyond that, because I think that my answer to this question is really central to our whole discussion today. The first few words of reading what Russell said include the reference to the economy as mechanical, and I think that that is not helpful. Applying the word mechanical, again, like the last question, suggests that it's governed by the rules of physics, the laws of nature, that it's a science, that it performs the same each time, that it is repeatable and studyable and extrapolable. And I think these are all wrong. And in fact, I always like I aggressively remind people that I'm not an economist, but I remind people that economics is called the dismal science. And I'm not sure it's a science at all, but if it is, it's certainly dismal in the sense that it is not, it's not like physics, where if you do A, you always get B. Sometimes you get C, or sometimes nothing at all. Richard Feynman, the great physicist, once said, physics would be much harder if electrons had feelings. You walk in a room, you throw the light switch, the light goes on. It always goes on because every time when you throw the light switch, the electrons flow from the switch to the light. They never forget to flow. They never decide to flow in a different direction. They never flow from the light to the switch. They never go on strike or complain that they're undercompensated. So the point is that economics is not a science, in my opinion, in the sense that if A happens, science is all about causality and predictability. And if A happens, then B is sure to happen. Well, that's certainly not true in economics. If A happens, B might tend to happen most of the time. That doesn't make it a science. So now let's talk about using these concepts to refer to investing, not economics. I have a presentation that I give called The Human Side of Investing, or The Difference Between Theory and Practice. And it was inspired by a quote from a great philosopher, you may know him or maybe not, since you're not American, Yogi Berra. And Yogi Berra was a great catcher for the New York Yankees in the 1950s, highly skilled baseball player, but famous today for the things he says, or maybe he didn't say them. One of the things Yogi says is, I didn't say, I never said half the things I said. But anyway, he once said, supposedly, that in theory, there's no difference between theory and practice, but in practice there is. And to me, that is the essence of this answer to you. It's the essence of my work. It should be, in my opinion, the essence of your work and the essence of your colleagues in this conference. What we learn in school, in my opinion, and what we should learn in school, is how things are supposed to work. That goes for the economy, and that goes for the market. But they might also help you by telling you, but you know what? They don't always work that way. That's a framework. That's a thought model. but it certainly does not govern all the time. And that's the key. The mechanical, Russell uses the term mechanical to refer to the economy, or if you apply it to the markets, the mechanical is the way things are supposed to work. The psychological or behavioral is all about the way things do work. And there's a big difference between the two. And, I have spent a lot of my career trying to reconcile the two, trying to reconcile the things that I learned as a student at the University of Chicago 55 years ago with the things that I've experienced in the markets since then. I was introduced to the concept of the efficient market hypothesis and so forth back at Chicago. I was very fortunate. Those things were developed mostly, I think, between 62 and 64. I got there in 67. So by definition, I was among the very first classes that was taught these things. And it was very helpful to me. Not in the sense that the Chicago School of Thought should govern your actions, but it should inform them. And as I say, I've struggled to reconcile the two. The best course I took, the Chicago, I went to Wharton as an undergraduate, which was entirely qualitative and pragmatic. And then I went to Chicago, which was entirely quantitative and theoretical. And most of the professors dismissed anything that was qualitative and pragmatic or was, quote, real world. But then I took a course in investing from Jim Laurie, who was co-head of the Center for Research in Security Prices. And his course was derided as Laurie Stories, because he would bring in actual practitioners every couple of weeks to talk about what they did. And that was considered heresy at Chicago. But for the final examination consisted of one question. You've learned the theory at Chicago. How do you integrate that with real world considerations? And I think that's the key. So I wrote a memo called What's It All About Alpha? You may recall that there was a movie called Alfie, and I think it was Michael Caine, and it was a long time ago, maybe 40, 50 years ago, and a song, What's It All About Alfie, by Dionne Warwick, wonderful song. Anyway, I borrowed the Alfie part and changed it to Alpha for a memo talking about reconciling the Chicago theory, and in particular, of course, the efficient market hypothesis with the real world. And as I say, I concluded, the hypothesis says because of the concerted actions of so many investors, security prices are right. And they price securities so that you can expect a fair risk-adjusted return, no more, no less. Again, that's how it's supposed to work. Certainly not how it does work. I think I said in the conclusion of that memo that if you ignore the efficient market hypothesis, you're going to be very disappointed because you're going to find out that very few of your active decisions work. But if you swallow it whole, you won't be an investor and you'll give up on active success. So the truth, if there is one, has to lie somewhere in between. And that's what I believe.
Okay, one of my own question, which I'll move now to, is, and in fairness to Russell, it was my introduction, and it's the definition of mainstream economics, which is mechanical, not necessarily that we agree with that. But just to continue on mechanical economics as a theory, indeed, in your memo on the couch, you talk about your own early exposure to the efficient market hypothesis. And for the audience, based on the rational expectations hypothesis, EMH states that markets are rational because any pockets of irrationality are averaged away. In contrast, you also highlight the reality of irrationality that can be observed in markets, something that both Alan Greenspan and Robert Shiller called irrational exuberance. Later, the GFC, or the global financial crisis, painfully hit home that what seems rational for an individual can be dangerously irrational if done collectively. So my first question is, can we square this circle? For example, is irrationality just about semantics, or is it something real that not only exists, but because of the collective dynamic can actually threaten the economic system and may thus not necessarily be averaged away?
To me, Patrick, the answer lies in my view of the efficient market hypothesis. Again, the efficient market hypothesis says that due to the concerted actions of so many investors who are intelligent and numerate and computerized and informed and highly motivated and rational and objective and willing to substitute A for B, prices for securities are right, such that they presage a fair risk-adjusted return. I believe that's the definition. But you get into a problem, because when I listed off the qualities that are necessary for a market to be efficient, I snuck in there the economist's notion of the perfect market and the requirements that the participants be rational and objective. And they're not. That's really the point. Economic man is supposed to make all these decisions in a way that optimizes wealth. But she doesn't, because she's not often objective and rational. She has moods. And those moods interfere with this arriving at the right price. So what my definition of the efficient market hypothesis is that because of the concerted efforts of all the participants, the price at a given point in time is as close to right as those people can get it. And because it is as close to right as most of them can get it, it's very hard to outperform the market by finding errors, what we call inefficiencies. I think of just mistakes. Sometimes prices are too high. Sometimes prices are too low. But because the price reflects the collective wisdom of all investors on that subject, very few of the individuals can find those mistakes and profit from them. And that's why active investing doesn't work, in my opinion. I think that my version of the efficient market hypothesis makes it roughly just as hard for active managers to beat the market as does the strong form that everything's priced right. But I think mine is more reflective of reality. And I think I wrote in one of my memos, maybe it was What's It All About Alpha, that I pointed out one stock that was 400 in 2000 and 2 in 2001. Now, it's possible, but to me, it's unlikely that both of those observations were right, but rather they reflected the consensus of opinion. This business, the idea, I shouldn't say this business, that sounds derogatory. The idea that inefficiencies will be arbitraged away by the operations of the market ignores one of the key elements that I think describes the reality, and that is mass hysteria. And I think that the markets, the economies, but more importantly, the markets are subject to mass hysteria. And I think it was on the couch that I said, in the real world, things fluctuate between pretty good and not so hot. But in the markets, they go from flawless to hopeless. And if just think about that one sentence, is it true? I believe it's true. And if it's true, then that shows you the error, because nothing is flawless and nothing is hopeless. But markets, I believe, treat things as flawless and hopeless. And there's the error. My book that I mentioned, Mastering the Market Cycle, I'm going to keep repeating the title in the hope that everybody will buy it. I am a devotee of cycles. I'm a student of cycles. I've lived through a half a dozen important cycles in my career. I've thought about them. I think they dominate what I do. And I got about 2/3 of the way through writing that book, and something dawned on me, a question. Why do we have cycles? The S&P, I mentioned Jim Laurie, the Center for Research in Security Prices, told us that about 40 years ago, 50 years ago, more, that from 28 to 62, the S&P had risen 9.2% a year, returned 9.2. Recent work, things have been better since. So I think that if you go back and look at the whole last 90 years, it's 10.5% a year for 90 years, the return on the S&P 500. Here's a question. Why doesn't it just go up 10.5% every year? And why sometimes up 20 and sometimes down 20 and so forth? In fact, and I've included this factoid in one of my memos, it's almost never between 8 and 12. Mm-hmm. So if the average is 10.5, why isn't it clustered around 10.5? Why is it clustered outside of the essential range? And I think
distorting also the normal distribution.
Exactly. And I think the answer is mass hysteria. And so I asked myself this question: why do we have cycles? And by the way, the same is true of the economy and mainstream economics, which of course you describe as mechanical, and I think that many people would describe as mechanical. But certainly, economics is driven by the decisions made by people, which are not always rational objective. It may be in theory they're closer to be rational objective collectively, but still they're not always, once you have people involved. But anyway, so my explanation for the presence of cycles, the occurrence of cycles, is excesses and corrections. You have a secular trend or a baseline statistic, but sometimes, so let's say that's the secular trend of the S&P 500. People get too excited. They buy the stocks too assiduously. They rise more than 10.5% until they get to a price which is unsustainable. And then everybody says, no, I think they're too high. So then they correct back toward the trends. But of course, given the nature of psychology, they correct through the trends to an excess on the downside. And then people say, no, it's too low. So then they bring it back toward the trend line and through it to an excess on the high side. So excesses and corrections, that's what cycles are, in my opinion. Where do the excesses come from? Psychology. People get too optimistic and then they get too pessimistic. They get too greedy and then they get too fearful. They become too credulous, then they become too skeptical, and so forth. Oh, and the big one, they become too risk tolerant and then they become too risk averse.
If I can just follow up on that, particularly for our cognitively inclined audience, implied in this, you suggest that there might be mental causality. And my next questions are basically also to motivate future research as part of economics revision. But during your September podcast, in which you revisit the On the Couch memo, you talk about causality and how complex it can be. and we agree and highlight this in our work. For example, when Alan Greenspan, in that famous 96 irrational exuberance speech, mentions the complexity of the interactions of asset markets and the economy, I'm quoting him now, it chiefly concerns, at least in our view, this dualism of the psychological of the former and the physical of the latter. Now, saying this, mental causality is highly controversial and complex in cognitive science, but cognitive science is the area that really studies this. So you also specifically refer to Soros's reflexivity in that context. And as you already indicated in just now, but also in your memo, you equate prices almost to psychology. And finally, we've all experienced this dangerous, to the point of existential, tail wagging the dog dynamics surrounding Lehman's collapse. So my first question is, if we agree that we will not gain much by identifying yet another behavioral bias, nor by running yet another regression, what would you like to see investigated by cognitive scientists that could potentially lead to more important insights, especially regarding our understanding of the interaction between these two domains of the real and financial economies?
Well, the people on this call know much more than I do about that latter subject of how to get to the bottom of these things. But clearly, there's so much grist for this mill. Now, exactly how you quantify mood and so-called animal spirits and so-called irrational exuberism is beyond me. But I think if we could, I always say, Patrick, and I think it's present in Mastering the Market Cycle, that if I could know one thing about every security that I was thinking about buying, it would be how much optimism is in the price. And because see, when you watch TV and you hear the newsreaders talking about what happened in the stock market today, you get the impression that prices are the result of fundamentals, and changes in prices are the result of changes in fundamentals. And that is vastly inadequate. By the way, they always say the market went up today because of X, or the market went down today because of Y. I always say, where do they go to find that out? Because I haven't found it yet. I haven't found where you go to have an explanation of change of the market's behavior, even after the fact. But it's not true that it's all about fundamentals. The price of an asset is based on fundamentals and how people view those fundamentals. And a change in an asset price is based on the change in fundamentals and the change in how people view those fundamentals. So facts and attitudes. So any research that could capture, changes in attitudes, I think is important. Now, what about quantifying the animal spirits? In one of the, I think, more jocular portions of my first book, The Most Important Thing, I have something called the Investor's Guide to Market Mood, or something like that. And I have a list of things in one column, and I have a list of things in another column. And whichever things are more predominant, you can tell whether optimism or pessimism is dominant in the market. But things like, do deals get sold out, or do they languish? Are hedge fund managers on TV or not? Who does the crowd form around at cocktail parties? What are the media saying? Going to the moon or cratering forever? I don't know how to quantify these things, but these are among the very important things that I listen to figure out where we are in the cycle. And I believe that where we are in the cycle plays a very strong role in figuring out where we go next. In fact, the title of my second book, Mastering the Market Cycle, when I was thinking about it, it was called Listening to the Cycle. Listening in the sense of taking our signals from where we are in the cycle. Listening also in the sense of obeying. The publisher thought that we'd sell more books if it said mastering the market cycle. But I think that I, as a practical investor, try to figure out what's going on around me. Now let's go back. I didn't follow the rules because I didn't answer Russell Napier's real question that you posed to me. Name 2 episodes that show this kind of thing in action. And I was glad to have your question in advance because it allowed me to think of the 2 I wanted to propose. In the spring of 2007, I wrote a memo called The Race to the Bottom. And this was when the subprime mortgage mania was at its apex, I think, and when the logs had been stacked in the fireplace for the conflagration that became the global financial crisis. It happens that I was driving around England in the fall of 06, maybe November, December 06, reading the FT. I mean, I wasn't driving and reading, I was being driven so I could read. And there was an article in the FT which said that historically the English banks had been willing to lend people 3.5 times their salary in a mortgage. But now XYZ Bank announced that it was willing to lend 4 times your salary. And then ABC Bank said, no, we'll lend 5. And that bidding contest to make the loans by weakening the credit standards seemed to me a race to the bottom. And I wrote that markets are an auction place where the opportunity to make a loan or the opportunity to buy a stock or a bond goes to the person who's willing to pay the most. That is to say, get the least for his money, just like in an auction of a painting. And so in this case, the bank that was willing to have the lowest credit standards and the weakest loans was likely to win the auction and be able to make the loans. Race to the bottom. And I said, I thought that this is what happens when there's too much money in the hands of providers of capital and they're too eager to put it to work. Mood. And of course, we all know the global financial crisis ensued. So now fast forward from February 07 to October 08. Lehman Brothers goes bankrupt on September 15th, 08. And now, rather than being carefree, the pendulum has swung and people are terrified. Rather than seeing risk as my friend in, the more risk you take, the more money you make, because riskier securities have higher returns. Now people say, risk-bearing is just another way to lose money. Get me out at any price. So the pendulum swings. And of course, the S&P collapsed, the prices of debt collapsed, and people's psyches collapsed. And so I wrote a memo right around October the 10th of 08. Maybe that day was the all-time low for credit. I don't know exactly, but it was called The Limits to Negativism. And I had an experience. I went to see a client. I needed to raise some money to delever a levered fund that we had that was in danger of melting down due to margin calls. And I went out to my clients. I got more money. We delevered the fund from 4 times leverage to 2 times leverage. Now we're approaching the point again where we can get a margin call. Now I want to delever it from 2 times to 1 times. And I met with one client who said, no, I don't want to do it anymore. And I said, you got to do it. I said, these are senior loans. The default rate on senior loans has been infinitesimal over time. And they're offering, I think the fund was offering a levered return of 26% a year from what I considered incredibly safe instruments. So this client, excuse me if I belabor this, but I think it's interesting. This client said to me, and this is all, I think it's described in the memo. Well, what if there are defaults? And I said, well, our historic default rate on high yield bonds, which are junior to these instruments, is 1% a year. So if you take 26, you take one off, you still get 25. So she said, well, what if it's worse than that? I said, well, the universe default rate has been 4% a year. So you're still getting 22. She said, what if worse than that? I said, well, the worst year in our experience is, the worst 5-year experience is 7.5. And if that happens, you're still getting 16. She says, well, what if it's worse than that? Or 19? I said, well, the worst year in history is 13. If that recurs every year for the next 8 years, you'll still make 13% a year. She says, well, what if it's worse than that? I said, do you have any equities? She said, yeah, we got a lot of it. I said, if we get a default rate of more than 13% a year every year into the future, what happens to your equities? Mm. So the point is, and I described myself as running back to my office after that meeting to write that memo, The Limits to Negativism. And what I wrote there is that it's very important when you're an investor to be a skeptic and to not believe what you hear. And most people think that being a skeptic consists of saying, that's too good to be true. But when pessimism is excessive, being a skeptic means saying, that's too bad to be true. And that particular investor couldn't imagine any scenario which couldn't be exceeded on the downside. So in other words, for that person, there was no limit to negativism. And when I can go out in the market and conclude that the other people in the market, that is the people setting the market prices, are excessively negative and excessively risk averse, then I, an inherently conservative person, my partner Bruce Karsh, who runs our distressed debt funds, an inherently conservative person, we go crazy spending money when we conclude that there's excessive pessimism, fear, risk aversion embodied in asset prices. And so it's not just the mechanical aspects that determine market prices. It's psychology. It's mass hysteria, which comes in waves from time to time that lead to these market cycles which prove excessive.
Before I go to my next question, I'd like to come back to your point where you say it's hard to quantify mood, but perhaps that's exactly the problem, that we're trying to capture it with analytical tools like Excel and MATLAB, whereas when, for example, you talk about we need to measure the temperature, and when we are perceptive, we can gauge it. It seems to me almost just like when you're trying to assess a mood in a restaurant, it's a qualitative aspect. And some people perhaps have this innate ability, whereas others would perhaps be helped with different methodologies and different tools, and that we can try to grasp mood better in that way. Because nowadays, people talk about market sentiment and trying to capture it by looking at the VIX or put call ratio or things like that, which I think you would disqualify as market mood. That's not market mood.
Those things are indicators or symptomatic, but they don't all move in the same direction at the same time. Sometimes A and B will go up and C won't. Sometimes A and C will go up, but D won't. So clearly they're not going. They also can't be dealt with in a mechanical sense. Yeah. But I wrote in one of my memos, and I think it was Risk Revisited again in 2016. I said that superior investors have a better sense for the shape of the probability distribution that governs future stock price movements, and thus a better sense for whether the expected return justifies taking on the negative aspects that lurk in the left-hand tail. I think that's it. And there's nothing in there about measuring, Patrick, or mechanical. I was locked up with my son for several months during the pandemic. He and his wife and their family moved in with us. And so we had a lot of talking He's an optimist. He's a tech investor. He would say he's not an optimist, that he's a realist. But of course, all optimists think they're realists, but all pessimists think they're realists. But anyway, he has an optimistic bent. He's a tech investor, venture capital. He runs a VC fund. He does a fabulous job at it. So we talked about these things in great length, and he made the point, which I embodied in a memo called "Something of Value," January of 21, about our conversations, and that's the memo that has gotten the most positive reaction from all of them for over 30 years. But he makes the point that because information and understanding are so widespread, so ubiquitous, that, as he puts it, readily available quantitative information with regard to the present cannot be depended on to produce superior returns. You have to have, everybody has those things. This is the epitome of the efficient market hypothesis. If everybody has all the same readily available quantitative information with regard to the present, then being a superior investor has to be a matter of going beyond that. You have to have something else. And if he's right in that description, then what are the things that can be the source of superior investing? And it seems to me there are two things. Number one, a better comprehension, if that's the right word, of the future. Some people see the future better than others, that could do the trick, because remember, one of the things on his list is information about the present. By definition, there's no information about the future, but maybe some people see the future better. Or the other thing that could be a source of superior results is qualitative. Remember, he said readily available quantitative information about the present. What about qualitative information? And qualitative information includes mood, what we've been talking about, the market mood. And so maybe some people have a better feeling than others about the collective psyche, and about whether it is too depressed and therefore presenting great opportunities to buy, or too enthusiastic, which is presenting great opportunities to sell or short. So the point is, a superior investor has to do at least one of those two things, and maybe both. And I think that's where the superiority comes in. And by the way, if we take it one step further and we say, well, how many people have a superior view of the future, and how many people have a superior understanding of the market mood? And if the answer to both is, well, not so many, then that explains why active investing has been a flop for most people who've tried it.
Yeah, excellent. Yeah, Howard, once again, thank you very much for sharing your insights with us, and we hope to welcome you in person one day in Panmure House. There are many questions, as you know, on my list that we haven't touched on. And those, I'd like to ask them perhaps one day, another time. But thank you.
Very good, Patrick. Thank you for your good questions and for conducting this discussion. And I hope it's what you wanted for yourself and your colleagues.
Okay, excellent. Thank you.
Bye.
Bye-bye.
So yeah, my talk is, Patrick asked me to give a talk on what if the market mind hypothesis was correct. And well, I have some thoughts on that, and that's what I'm going to try and explore. Before I do, as you just heard, I'm a practitioner, not an academic at all, I'm going to, frankly, I'm going to be talking about things that I don't really know very much about, and you might think, well, who the hell is this guy to be talking about this stuff? And the answer is, nobody. But Patrick asked me, so I'm going to do it. As a practitioner, there's things that I think I do know about, and I want to talk about that as well. And I want to try and kind of integrate those things. Howard Marks is a guy who's been a kind of hero of mine, actually.
for most of my career. I agree. I found myself kind of nodding furiously with a lot of what he was saying and a lot of his kind of market anecdotes. But he started out by saying things which I actually want a theme of the next few slides is actually going to take the other side to what. Sorry, I'm told to stay over here. To what Howard Marks was saying, and that's this idea that economics isn't a science. I really think it is, right? I think it's not done by very good scientists, right? But that's not the same thing, right? It is a science, right? And again, related to this idea that, you hear this criticism a lot, we've heard it a few times today, the problem is, economists try and use mathematical models. Well, again, of all the sticks that you could beat an economist with, I think that's not one of them, right? If mathematics is the language of nature, the economy is a natural thing, right? So presumably, the secrets can be uncovered by mathematics. And I'm going to argue that case, and I'm going to give some examples where things which had previously been thought to be very enigmatic and mysterious and beyond the kind of realm of scientific inquiry have actually been penetrated, and I think we have a pretty good understanding of some of these things now because of the use of the correct tools. So I'm going to argue that we should actually be using the correct tools and make a couple of kind of suggestions about what I think those might be. Okay, so let's see this. I'm going to start off with this kind of idea that we've already heard about, so I'll try and be quite quick through here. The notion of science as a metaphor. I think, when Patrick asked me to talk about, what would it be like if the market mind hypothesis was correct? Well, the problem I kind of had quite quickly was that I'm not really sure it is a hypothesis, right? I think it's a metaphor, right? It's not a hypothesis that's got a testable conclusion. How would we know? If someone thinks it's a mind and someone else thinks it isn't, then how do you reconcile that difference? What's the kind of testable implication? Actually, kind of interestingly, there are some guys who are trying to kind of develop techniques for, actually quantifying consciousness. And so maybe one day we could actually test a hypothesis. But for now, I'm just going to say, listen, I think it's a metaphor. And in saying that it's a metaphor, I also want to say that I don't think this is a bad thing at all, right? Far from it. I think metaphor is very important. Analogy is essential to the way we talk, the way we communicate concepts. If you try and explain to a kid, what a mango is, right, it's actually quite a kind of tricky thing. Do you know what a mango is? Dad, well, it's kind of like a fruit. Well, is it like an apple? Well, not really. It's kind of, it's kind of bigger and mushier. Is it like a banana? Or not really. It's kind of different color. It's about, you're already starting to talk about things that they understand as a way to explain something that they don't, right? And I think that's actually a very interesting kind of heuristic that we use, this kind of pattern recognition heuristic. But there's nothing wrong with analogy. It's absolutely fundamental. You might talk to someone about, a song you heard. You say, well, it was kind of, it was a bit like George Clinton and Kraftwerk stuck in an elevator, right? Powerful. These things can be very powerful, right? It's a very, very powerful tool. So by saying that it's a metaphor, again, I just want to kind of emphasize that this is okay, right? This is very, very kind of legitimate. Douglas Hofstadter, another one of my kind of intellectual heroes, he actually kind of makes the point that analogy is the core of cognition. He says that analogy is the interstate freeway of cognition. It's the motor of the car of thought. Right? Again, it's very, very difficult to kind of explain concepts to people without at some point using metaphor. So, we use it with kids, we use it with each other. Scientists use it as well. Scientists use metaphor. You're familiar with these very well-known metaphors. We've got Schrodinger's cat. We've got Maxwell's demon. We've used to explain entropy and thermodynamics. We've got at the bottom, this is actually Newton's clockwork universe. He kind of famously compared the universe to God's clockwork. So again, there's kind of metaphor analogies is deeply embedded in the way we communicate ideas, and this isn't just for kids. This is for kind of scientists as well. So to say that the market mind is a good hypothesis or or a better hypothesis, I think that that's something that, well, I think that's a kind of interesting question. I think that's a very, very legitimate question. Arguably, science progresses through improving metaphors. One of my kind of favorite examples is from Harvey. Before Harvey was a physician to King James I. Before him, people thought that the heart was a kind of distillery, right? It would purify blood. Right, so the top chamber you would have impure blood, and then it would go through the heart, and then the bottom chamber it would be pure blood, and that's how the body kept itself healthy. So that when you weren't healthy, if you had a fever or something like that, it was because you kind of had some kind of problem with your blood, and you needed to have it cleansed. And the way you would get it cleansed, so you kind of strategically located leeches, right? And then Harvey comes along and says, well, no, actually, the heart's much more like a pump. Right, what it does is it pumps blood around, and it circulates blood around the organs, the extremities, and actually the blood circulation occurs within this kind of closed network, and obviously this led to kind of breakthroughs in understanding diseases. It actually coincided with roughly the end of leaching as well. Again, this is just one example. I think we've seen a few over the last few days, so I won't kind of labour the point. The question is whether or not the mind is a better metaphor. Is it a good metaphor? What makes one scientific metaphor better than another? And I think there's probably three things that come to my mind. The first is that it feels like a more accurate representation of the world that we see around us. The second is that it allows for the accommodation of more interesting questions. Right, and this is something that is absolutely essential. This is something that I'm going to explore in a moment. And relatedly, it suggests new directions for research programs. Right? And I think we're already seeing that today with Patrick's program here. So part two, the dominant metaphor in economics. Again, I don't need to labour this because I think it's been kind of referenced enough over the last couple of days. We're very kind of familiar with it. But this notion that the economy is this kind of mechanical machine. This is absolutely the dominant metaphor in economics. It remains the case today. It certainly was when I was doing undergrad economics, and I think it probably has been, certainly for 100 or so years. For those who are non-economists, this kind of the easiest way to see this is through you must have heard of the notion of equilibrium. And the equilibrium state of a market, the equilibrium unemployment rate, the equilibrium interest rate. We hear in financial markets, people use the term equilibrium equity valuations, right? This kind of notion of equilibrium. This comes from closed linear systems that we see in actually high school science. So this example here, this is actually just the example of a beaker of water that's got a kind of a lid on it. If you apply some heat to that water, what you find is that you get some evaporation, and as some of that water is evaporating, then the water level will drop. But again, what will happen is the lid will gather some of that water, it will condense, and then you get the rate of condensation will actually lead to the water level going back up. And as soon as the rate of condensation and the rate of evaporation are the same, and they're equal, then you get this kind of new equilibrium level of the water. And of course, if you change the heat and apply new, then you get, again, you get these kind of temporary disequilibriums, but the system naturally tends towards this equilibrium. And economists have borrowed this concept. This is how markets work, right? You get demand, you get supply. Demand equals supply. The price at which demand equals supply is the price at which that market is in equilibrium. If you get a disturbance in that market, whether it's an increase in demand or it's an increase in supply, price is what equilibrates, right? I'm even using the language myself, right? Price is what adjusts to generate an equilibrium in a market. Now, that's the metaphor, because if markets tend towards equilibrium, then the economy is just a whole bunch of different markets. And if they're all tending towards equilibrium, when we've got a general equilibrium, then the economy is in equilibrium. And the economy will tend towards equilibrium thanks to this kind of mechanical metaphor. Now, there are some successes behind, I think, this type of thinking. One of which is that it does lead to kind of tractable theoretical solutions about what an economy should look like, how an economy should behave. You can start to play around with kind of ideas, and you can play thought experiments. Well, what happens if there's a disequilibrium in the capital markets? How does that kind of ripple through into the rest of the economy to restore general equilibrium? Which prices have to change, right? And policymakers can say, well, we've just got disequilibrium in the commodity markets. The price of oil has gone through the roof. This has led to a reduction in demand. We've now got disequilibrium in the labour markets. How can we restore equilibrium to the economy? So again, this framework is maybe an okay way. It's not a completely awful way to think about, what they should do, whether or not they should do anything, et cetera, et cetera. Maybe, I think quite interestingly, this slide here actually is just a kind of screenshot of a very well-known YouTube clip by a very famous investor called Ray Dalio. He's the founder of Bridgewater Associates, also a fascinating guy, very, very interesting firm, very, very successful investor, with a very, something like a 40-year track record or something like this. So the guy's not an idiot. He has this kind of, he's a macro investor. Right, so he invests in the way he thinks the economy is going to unfold, what's going to happen to prices, what's going to happen to commodity prices, to interest rates, etc., etc. You can see from the title how the economic machine works. The economy as a machine. He thinks that his model of how the economy works, how the economic machine works, is largely behind his success as an investor and the success of his firm as an investment firm. So, the first kind of question we ask when we're saying, well, is a metaphor useful? Is it useful? And I think the answer is yes. It has been useful, right? There's some good things. So I don't want to just completely kind of trash it. But could we have a better metaphor, right? And I think that we could. And the reason for that is because of the questions which I think are very, very interesting and are actually very, very pertinent today that this mechanistic model cannot answer, right? So here's the first one. Again, for non-economists, and maybe even some economists, right? But for non-economists, this is very surprising, right? Where does prosperity come from? Where does it come from? What is this wealth creation, right? Why are some countries rich and others poor? Why are some regions rich and others poor? How does it work? Right? How do we actually understand this process? And the answer is, economics is very, very quiet, right? We just assume there's this kind of lump of wealth, and then, and it's all in equilibrium, and then maybe something happens and we can move it around. And politicians like to think about distributing it. Okay, and that's redistributing it, I should say. Okay, and that's right, but where does it come from in the first place? Right? And again, economists, we don't really have good answers to this, right? We said there's certainly no consensus about it. Here's the second one. How is prosperity distributed, right? What's the distribution of wealth, right? You hear a lot, certainly over the last few years, about income inequality and actually wealth inequality. These are political issues. I think there's a general feeling that it's gone too far, right? There should be a redistribution. We need to fix this. But I've seen work on Gini coefficients. Gini coefficients are the measure of inequality. I've seen measures of Gini coefficients estimated in ancient Greece, believe it or not, which show Gini coefficients off the charts compared to where we are today, right? By the way, that's not to say anything about the current state of the debate today, whether it's a good or a bad thing, but what's informing this thinking, right? Because this Greek stuff, and you can see that I think that the same analysis was done in the American South in the 19th century. Unsurprisingly, there's a very high Gini coefficient there, and also in Henry VIII's England. The conclusion was that the Gini coefficients were generally higher then, right? The point I'm making is there seems to be something very persistent about inequality. And so there seems to be something very uneven about this distribution of wealth. What is it? Does anyone understand it? Where does it come from? Why? What's too much? What's not enough? What's good? What's natural? What's not natural? These are questions that this mechanistic model that we use just says nothing about, absolutely nothing about. And then third, something that Howard just alluded to, and again, this might be very surprising for non-economists, right? But why does it cycle? Where do the recessions come from? Where do financial market collapses come from? What's behind it? Why did it keep happening? Why do we never learn? Why? Right? There is no good answer. I mean, we've heard about Minsky earlier. There are some kind of interesting theories, but frankly, these are quite fringe. They're certainly not in the mainstream. Why not? Remember, we have this very static equilibrium, general equilibrium metaphor. The economy always tends towards this equilibrium, right? There's no real way of understanding. Cycles are not a part of it, right? There's no cycle in that beaker, right? A beaker of water, that's just it. That's the water level, right? So, this is these are things that that we can't answer. Now, here's some experiences that I've had. I absolutely know for a fact. Here are the things that I experience every day. And again, these are things which they just cannot be accommodated within the current framework. A question I asked earlier is related to the first one. What is the information content of a price? When I forgot his name now, I think it was Pritchard, he said, well, information is not knowledge because we don't know how to reconstruct it. Information absolutely is knowledge. I'm telling you, right, it contains knowledge. Now, we might not be able to deconstruct it, but anyone in the market will know that a market price contains information. It contains an expectation. Howard Marks said, if there was one thing that I would want to know about security performance, how much optimism is in the price? This is a variable, this is a piece of information, and it's somehow, very mysteriously, it's embodied in the price, right? What is the information content of price? Again, there's nothing. There's absolutely nothing in this kind of mechanistic view. Alpha decay. Alpha decay is the process by which, I think it was I can't remember the two guys now. I think it was Sick Boy and Trainspotting, famous 90s film Trainspotting, kind of grand theory of everything. One day you've got it, then you haven't, right? And that kind of explained everything. That's alpha decay. You get these hot streaks that can last for years. Investors will do very, very well, and then it all just disappears. It just evaporates. And what seems to happen, well, we'll come on to that in a moment. I can see what happens, right? But again, this is not something that you can really answer in this mechanistic system. And then the reason we're all here today, what is the market mood? Again, there's been a lot of kind of discussion and kind of conversation about whether or not there is a market mood. Again, all I can say is there just absolutely 100% is a market mood. We were talking about it over dinner last night. I wouldn't overplay the kind of bipolar thing because that kind of implies that the market's just not rational. And generally it is. You'd be amazed at just how rational the market usually is, right? It just has these kind of fits sometimes, right? But there is absolutely a market mood, and it's kind of like if you're sitting at a table with your kind of family and someone's just had a really bad day and everyone around the table knows about it and everyone can feel it, and and they're not saying anything, but we all know, right? And there's that mood, right? That's what the market can do to the environment. That's what the market does too. So the market absolutely has this a mood which is kind of tangible. But again, how do you think about that? Right, that's the hardest one of all. Right, this is exactly Patrick's kind of hard problem of finance. Interestingly, in the physical world, that's the hard problem of science. Right, because it is a thing. Right, it may be difficult to measure and difficult to even, but it is a thing. Right, can we try and explain it? So why can't we try and explain? If physicists are trying to explain it, trying to explain consciousness, and neuroscience explain consciousness, as we'll see in a moment, why can't we be trying to explore this again? The mechanistic metaphor offers nothing, right? And therefore, I don't think it is such a good metaphor, and I would like to see this kind of market mind. Now I'm going to spoil the punchline a little bit, but here's just some kind of more kind of tangible ways in which I think that I could imagine some very kind of fruitful and certainly very, very interesting research programs if we were to kind of switch gears and if economics departments were to actually just kind of start again. Sometimes that's the right thing to do. Just put this stuff in the bin, let's start again. I think that wouldn't be a bad thing for us to do. Does it offer a better description of what we see around us? So remember I said earlier on, yes it does. Is it able to accommodate new question directions? Yes it does. In what way is it a better description? Markets and just more broadly the economy, what is it? It's interacting and exchanging people, right? Human beings, living things, right? That's what it is, right? Markets are living things. They're alive. The economy is a living thing. It's alive, right? We do actually have tools to study systems which live. Why are we using the tools from systems that study things which don't live? This should not even be controversial. It's just so, what are economists thinking? Why do you think you'll get more insight into studying, protons and electrons than you would by studying population dynamics in the field, right? So I think that doesn't kind of make sense to me. I said that I talked about alpha decay, and what it was is the kind of situation where you'll get a very successful investment strategy. You'll have an investor who performs very, very well for a period of time, and then it just disappears. And then some new strategy suddenly makes a lot of sense, right? And that works for a while, and then it actually kind of doesn't work. Now, the reason I know a little bit about this is because in my day job at Calderwood, what we do, the hedge fund I run, is actually about trying to produce very, very stable, predictable, unvolatile returns, regardless of the market environment, right? And that's actually very, very hard. Why? Because pretty much every single asset, and certainly every single strategy, is a function of the environment. It's always a function of the environment, right? We've just seen, there's a lady called Cathie Wood, you may have heard of. She built a business. It seemed to me to be her business model was to buy the worst companies you could find, run by the least reputable people you could find, with the worst business models you could find, with no cash generation, but with some kind of story, right? That's what she did, and it went really, really well. Now, 5 years ago, we said, who would have taken that kind of idea seriously? But the answer is that worked. That worked in the particular environment and that we found ourselves in. And everyone who was actually saying, well, oh my God, this is just bloody stupid, isn't it? I mean, she's not paying any attention to value. She's not doing the homework. Oh, those guys who were paying attention to the value and who were doing the homework, well, they didn't do anything. They didn't make any money. Why was that? Because the environment was not conducive to that strategy, right? Now, again, what does a mechanical model inform us about that type of dynamic? Nothing, right? Literally nothing. Whereas what we see, I'll tell you what happens, right? Someone comes up with a strategy, and that is a great success, right? To such an extent that it becomes the dominant strategy. Right? And because it's the dominant strategy, everyone now copies it. So what happens when everyone copies it? Well, now you've got the same people who are trying to buy the same stuff. So the stuff that was a bit cheaper earlier is now a bit more expensive, which means that the future returns are going to be lower. And they're doing the same with their sales. They're selling stuff. So they're actually selling stuff lower rather than higher, right? In other words, this process where the market seems to learn, right? Without consciously thinking about it, the market seems to learn this is the dominant strategy. It kind of absorbs this dominant strategy, and in doing so, the environment has changed. And now the environment's changed, that's not the dominant strategy anymore. Then it implies that there's a new dominant strategy. And so this interaction between strategy, environment, back to strategy, back to environment, right? This, again, is something which is absolutely biological. And this is absolutely something where you do have mathematical techniques to study this type of phenomena. This is absolutely predator-prey type evolutionary processes. Why are we not looking at them? Right, because that seems, I said, I can see this every single day. This equilibrium, static equilibrium thing is a kind of nonsense. Is it able to accommodate new questions and directions? Well, as I said, I think so. I think there's a couple of really interesting kind of aspects to, I suppose, in science, which you might have thought, or certainly we would have thought kind of, a few decades ago, that were just too cosmic. Right, and they didn't really lend themselves to scientific analysis. One of them is the concept of trust, the notion of trust. I don't know if you're familiar with the guy called, the Harvard biologist called Martin Novak, and he's kind of studied, he's basically used kind of dynamic game theory with a kind of Darwinian overlay. He simulated this, he simulated these worlds, he simulated these population dynamics, and he can generate cooperation, right? He can see where trust comes from, right? So this kind of notion of trust, right? We can see where this comes from. Now we feel that we have an understanding of something as woolly as trust. We can understand morality. We can understand concepts like good and bad. What's the origin of these? 50 years ago, it was God. It was something to do with religion, probably, right? You needed religion to give us morality. Now we know better, right? Again, that's because we've applied proper scientific techniques, proper mathematical techniques to a hard problem, and we've got ourselves a good, solid, workable, rigorous answer. Right? So that's one example. Another example is consciousness itself, right? I think there's the Edelman's Darwinism model of consciousness, where he actually has the competition between neurons and neuronal activity at the kind of substrata layer, which can actually generate, so competitions, adaptive behavior between these different regions of the brain, these different neurons, and it generates, in his model, it generates the properties and the functions that we see in a brain. And those properties are cognition, they are memory, and then they are consciousness. So we start to have, and by the way, it gets very information theoretical, right, when you get into kind of Edelman stuff. So again, this isn't just woolly nonsense. This is using the right kind of mathematics. Now, maybe Edelman's theory isn't quite right, okay? But the point I'm making is we're getting somewhere. We're getting somewhere with something we thought was just completely intractable, right? But we're now starting to get somewhere. So when I hear people say economics, well, it's not a real science, I think, well, people did just say that about consciousness, not that long ago, and look where we are, right? So yes, I think that this could all come about with the mind as a better metaphor. I'll run through these quite quickly. In fact, I've already been through those ones. Some of the other things that I would just like to kind of touch on very, very briefly. 4 kind of just ideas, and there are more. But I said, what is prosperity? Well, according to the Society for Neuroscience, it says on this website, the fundamental question neuroscience seeks to answer are how neural stems evolve, integrate, encode, and compute information. Right? I think it probably should be neurosystems, sorry. Right? That's an economy. That's what an economy does. Right? That's exactly the same thing. How markets evolve, integrate, encode, and compute information. That's all that's all markets are doing. Right? Every single day, every single minute, right? The distribution of prosperity, well, again, I'm kind of not quite on terra firma here, so then cognitivists, feel free to shoot me down, but my understanding is that one of the kind of recent developments is that neuroscientists have realized that the interaction between kind of neurons is actually not normally distributed. It's characterized by fat tails and very, very uneven distributions. This is absolutely something that anyone in finance will be very, very familiar with, right? Nature is wild, right? Financial markets are wild. They do not obey a very well-behaved symmetric normal distribution. They have very, very fat tails. They do absolutely crazy things. And as I said, it's not just in the distribution of wealth, it's in the current change in prices. Again, you see these kind of distributional parallels between an economy and between a brain. Here's another one. Is there such a thing as economic plasticity? Right? We've just hit Russia, the Russian economy, with enormous sanctions. What's it doing? Has it just collapsed? Well, no, actually, it kind of has a bit, right? But what they're doing is they're reconfiguring the supply chains. They're selling stuff to China instead of us. They're doing deals with the Chinese and with other Asian economies instead of Europe. And in other words, they're reconnecting the neurons, right? So this kind of and by the way, is that what we wanted? Did we want them to do that? Did we actually think about that? Again, these parallels, I think, maybe it's just a metaphor. I suspect there's some deeper underlying structure which they both have in common, right? And I think that's what we're trying to understand. And then last one, where do recessions come from? Well, here's a chart. It's not a very good chart. I actually tried to get the original data. I haven't been able to yet. So I just kind of took a screenshot of the clip that I was watching. But this comes from a neuroscientist called Ramon Era. And interestingly, he's coming up with ways to develop, he's trying to come up with techniques to measure consciousness. Right? So remember I said at the beginning, market mind hypothesis. Well, it could be a hypothesis if we could test for whether or not the market had a consciousness. And there are people trying to figure out ways to do that. But one of the things he's noticed, he actually took this, basically, these two charts here show the correlations between neural activity in two different, between roughly 150 brain regions. The one on the left shows basically no correlation. There's no correlation, very little correlation between these neuronal regions. And that's the state where the subject is not having a seizure. This is when they're just normally kind of conscious. The one on the right shows what happens when the subject has a seizure. And suddenly, all the neuronal waves correlate and start to move in sync. They all move at exactly the same rhythm. And this is very damaging, it seems, for the brain. Now, I think anyone in finance will look at that and absolutely instantly recognize what they see. They'll instantly recognize that as a cross-asset correlation matrix, right? That's what they'll see. When the markets dump, when the markets really get hammered, what happens is everything correlates. Everything moves in exactly the same direction. So this kind of market malfunction seems to have, again, maybe it's just a coincidence, maybe it's just a metaphor, but I just wonder if there's a kind of deeper underlying structure in common. And if there is, this structure will be mathematical, right? This is the use of mathematics and science. So again, there's nothing wrong with mathematics. Just don't use them. Don't abuse mathematics. Use mathematics. So the final conclusion, I'm going to leave you with a quote from John Wheeler. John Wheeler, famous quantum physicist, who actually supervised Richard Feynman's PhD, again, central to the Manhattan Project. Towards the end of his life, he got very, very interested in quantum information theory. And we've already kind of heard this kind of notion of where the mind kind of begins and ends. It's not necessarily all in the skull. Given his kind of quantum expertise and the importance of observation to determine outcome, Wheeler wondered if we actually had things the wrong way around. And Wheeler actually wondered if the universe was actually a mind, right? And this is what he said, are life and mind irrelevant to the structure of the universe, or are they central to the universe? Carl Sagan has very famously wondered if the mind and consciousness is the way the universe understands itself, right? So if physicists are allowed to ask themselves if what they're actually looking at is a big organism and a big mind, then I think that we are allowed to do the same.
Oh my gosh, that was quite something. I thought my job was to ask questions, your job was to ask questions, and Howard's already answered lots of questions, but Dylan's just posed half a dozen brilliant questions at us. So that's going to take a little bit of time to digest. In the meantime, I think I'll get the conversation started with one question for both Howard and Dylan, and then open up to you. And you mentioned the point, where does mood come from, Dylan? And I'm interested, what influences mood? And one of the things that occurs to me, like listening to the conversations we've heard about narratives and storytelling and framing in markets. We heard from Merrin yesterday about incentives, misaligned or perverse incentives in markets. And it occurs to me that there are many players in markets with different incentives from what you might imagine, or completely opposing incentives. Entrepreneurs who want share prices high so they can raise capital at a low cost of capital. Brokers who want more activity regardless. A whole series of players who want things to behave a certain way. And my question to both is really, to what extent is, because of these narratives and these different incentives, are we being manipulated in our mind? Is the mind of the market being manipulated by people, some of whom are in the market, but some of whom perhaps are outside and trying to play them players within the market? So that's the question. How much are we influenced by manipulation? And what does that mean for people who are in markets to have that kind of phenomenon taking place?
Well, God, that is a big question. I'm trying to think where to start. In my experience, and again, this goes back to something that was said this afternoon, that I think it was Professor Pritchard said he didn't think it was very likely that people wouldn't know what a price was. When traders were trading with one another, and the price of September wheat was X at the end of the day, they wouldn't know what that was. He thought that was very unlikely. Of course, they would know what it was, and actually, in my experience, they don't. Generally, don't. And the kind of proof for this is that there is no end to the surprise that the price gives you. The amount of times something will just move and nobody quite knows why. The amount of times where, look at predictions, look at the predictions from the banks and from the media. about where they think the markets are going to go in the next month, in the next 6 months, and the next, right? People always get it wrong. People don't know because they can't actually predict it. They don't know. And in my experience, there have been attempted manipulations, and there is often this idea that markets are being manipulated by someone. Again, prices are very mysterious things. We don't really know what they are, how they're constructed. They feel external, even though we're the ones that created them. And I saw that it can be the type of environment that invites conspiracy theory. And so you often find people who think that there's people with dark glasses who are manipulating the price. But in my experience, that's never been the case. I think the market's just far too big for that kind of thing. In terms of the narrative manipulation, is media playing a bigger role now? Is social media playing a bigger role? I'm not really convinced. I think if you look at the South Sea bubble 300 years ago, you can see it wasn't just a London thing, it was actually a European thing. There was no social media then, there was barely any media then. The only information that you had to digest was price, and that was enough. That was enough to trigger global contagion. In other words, this kind of mood had shifted, over the channel and onto mainland Europe, and that was 300 years. So this does seem to be something very kind of fundamental about that mood. And as I said, I feel very much that it's to do with that sense that the price is something outside of you, even though you participated in the market and therefore you contributed to forming it. It's something that isn't you, that you don't understand, and it has the potential to hurt you, and so there's a kind of fear of it, and I think that's where this mood comes from.
This is what you've thrown at us in this question is so new that my thoughts are unusually disorganized, and that'll probably become clear. But I agree with Dylan that for the most part, markets are not manipulated. I mean, the big markets are not manipulated. The U.S. stock market is just hard to manipulate, to the extent that manipulate means made to do something intentionally by some actor. Most people don't have that power. By the way, you mentioned earlier that different market participants have different motivations, and I think that's absolutely true. And of course, it's desirable, I think. But many people, as you say, companies want security prices to be high so that they can finance cheap. People like Oaktree want, and Warren Buffett want prices to be low so they can buy bargains. And Buffett says, I like hamburgers, and I eat more hamburgers when they go on sale. And so, yes, of course. But as I say, and Dylan says, nobody can move the market. And I'm very proud to be on this panel with him and in agreement on that. The other thing, but I want to mention, I think that any attempt to discuss the market as rational, not to even mention mechanical, breaks down, as I said in my remarks with Patrick, when you realize that many participants are not rational and objective, they're highly emotional. And the other thing is, and this may sound snobbish, I think the vast majority by number of investors don't understand what makes for value, what makes for something that's worth appreciation, don't understand what makes for intrinsic value, and consequently can't have a sense for when the price and the intrinsic value diverge. So if you think it's a market of intelligent participants, that's one thing. If you think they're just punters, it's something very different. And there was something happened a couple of weeks ago. I think it might have been the announcement of the 0.5 point raise by the Fed, and it came at a given point in time in an afternoon, and stocks went way up. And then the next day, with no other visible news having intervened, stocks went way down. So I really am very leery of imparting intelligence to the market. At best, this was captured, at minimum, this was captured by Ben Graham in The Intelligent Investor, who said in the long run, the market is a weighing machine, but in the short run, it's a voting machine. In the long run, market prices, I think, tend to reflect value, but in the short run, they reflect psychology, opinion, love and hate and fear and greed and all those things.
I just wanted to make a comment stroke a question again for the two of you. In both of your remarks, you said that the markets for the most part are rational, but obviously there are episodes when that may not be the case. And James asked a question about incentives, and it seems to me there may be a linkage there, that when you have highly motivated, incentivized people to either make money or avoid large losses, you might get those sorts of outcomes. And the market mind itself depends on processing information. But here's I don't know if I'll be clear in this next observation, but it seems to me that we live in an age now of unprecedented information and unprecedented disinformation. And that particularly applies to arenas like social media and politics, where I'd be hard pressed to say that the outcomes are rational that we see around us in many respects. So isn't James in fact right that there's something about the way markets process information through essentially a set of incentives that generates the kind of outcomes that you are broadly seeing that may not be true in other systems?
Could you repeat the last part of that question?
Well, again, James had asked about incentives and the importance of them. And it's what I was thinking about too when you were speaking and when Howard was speaking to you before, that markets are processing information, but through a prism or through a factory, if you like, another metaphor here, but that is guided by their incentives to either, again, make money or hopefully not lose too much money. In ways in which we process information elsewhere in society, we don't have those same incentives. They are different incentives, perhaps, but it seems to me that in today's world that we look outside of markets, we see lots of examples of what I would personally call borderline irrationality about how people are processing information, whereas you and Howard have both said that markets for the most part are actually rational within some exceptions. Well, so just thinking about linking incentives to those outcomes.
So I understand the question now. So you're saying outside of markets, there seems to be this kind of hysteria everywhere, whereas, when you look around and you see this hysteria everywhere, how can you say that markets are not affected by this? How can they be rational? I would say that it's different. Anyone can fire off a tweet. Anyone can fire off an angry tweet. Anyone can write a headline in a newspaper. It's not the same as actually having your money on the line and trying to buy something or trying to sell something, right? Because if you get that wrong, it's kind of painful, and it can be quite a scary, and that is the right word. It can actually sometimes be quite a scary experience. There's a very famous investor called Seth Klarman, and he said that when you know that you're getting a bargain, you know that you're getting a good deal because you want to puke, right? When you're buying, you want to throw up, right? You're terrified, but you do it anyway, right? And the reason that works is because you can guarantee that if you're really terrified, the rest of the market will be terrified as well. Why would the market be terrified? Because the prices are just completely collapsing. Who the hell wants to buy? Nobody wants to buy. That's why the prices are falling so heavily. The market is gripped with fear and panic, and as someone who's in the market, you're also gripped with fear and panic. How do you over time make money in the markets, do better, what Howard talks about as a superior investor? Well, you have to learn to do things that most people in the market are not doing. You have to do something else, right? So it might not be an informational advantage at all. It can be a constitutional advantage. You're just, unusually capable of buying when everyone else is absolutely terrified. I can certainly say in my own experience, and this works both ways for buying and selling, It's certainly, in my experience, the best investments I ever made have been when I actually have felt quite sick about actually buying in this crazy market. And the flip has also been true. I've sold during manias, and it's actually been quite painful to sell, because it's almost like saying goodbye to a friend who's been so good to you, right? They've just made you a lot of money, and now you have to kiss them goodbye, and you don't really want to. You want the ride to last another month. So again, it doesn't feel right. But yeah, I think in investing, if it feels right, it's probably wrong. And I think that's a kind of, that's kind of interesting. But that's a very, very big difference. That experience, that sensation of pain, of fear, of nervousness, of anxiety, that's a very different experience from writing a newspaper headline, firing off a tweet about how the market looks cheap. It's not the same thing. So I think that there is a bias for markets to be probably more rational than other parts of the economy. Although, of course, they can. Typically, what happens when they go completely irrational, and I'll hand over to Howard here, is everyone makes the same mistake at the same time, right? So markets are usually, I think, smart when there's, like as we saw with the kind of the scans of the brain, right? When there's a lot of heterogeneity, there's difference of opinion. When everything suddenly sinks and everyone makes the same mistake, that's when you get the seizure.
Yeah, I'd like to go on from that before I forget all the thoughts that Dylan has raised in my head. But I think I wasn't in the brain scan discussion, but I would say, Dylan, that the market is more rational the more heterogeneous the thought is, and the more homogeneous it is, the dumber it is, because error and emotion and psychology take over from ration. I want to comment on something you said in answer to the first question. It may come in here, but you said, we had a South Sea bubble, but there was no social media at the time. And the fact that you can have bubbles in the absence of social media doesn't mean social media isn't influential. And when you talk about incentives and that kind of thing and inputs, I just want to mention that, I guess I was on vacation, or anyway, away from civilization, in the summer of 20. We were all hiding out from the pandemic, and I was in the Hamptons, and maybe not, I guess I was working on internal stuff and not that connected to external stimuli. But that's when I came back, and I heard about the Reddit bulletin board and all the trading and the meme stocks and the Robinhood and all that complex of things that were very, very interesting. But there was a guy, and he was like the mascot or the leader of this band of merry men trading on Robinhood, and his motto was "Stocks only go up." And I think people believe that, and because of that, because people had a ton of money from government largesse that they couldn't spend because they couldn't go out of the house. B, a lot of people didn't lose their jobs, so they're actually richer than they had been before the pandemic. And the casinos were closed, and there were no sporting events to bet on. And so this guy says, and Robinhood offered free trading. So this guy says, well, let's trade. And why wouldn't you? Because stocks only go up. And so retail investors flooded the market and took over the trading in Hertz, I guess, and GameStop and AMC theaters and a few things like that. So that was, I think what we have to do in a way is we have to separate rationality from correctness. To invest your money in the stock market because you're told that stocks only go up is rational, but it's not correct. So this was something very much the opposite. I'm glad that Dylan jogged my thinking by mentioning Seth's inelegant reference to puking. Dave Swenson, who very successfully ran the endowment at Yale for upwards of 35 years, wrote a book in '98, I believe, called Pioneering Portfolio Management, and it had one of the real gems that I use over and over again. And he says that something like successful investing, disregard the wind up words. This successful investing requires the adoption of uncomfortably idiosyncratic positions. Those two words, uncomfortably idiosyncratic, are everything. And because, the pendulum swings, and okay, maybe I can pull some of this together a little bit. In the middle, when the pendulum is close to what my mother used to call the happy medium, is close to intrinsic value, thought is heterogeneous. Buyers and sellers are pushing against each other, and I would say the market is rational. But then the forces in one direction or the other take over. The thinking becomes homogeneous around those forces. The pendulum swings to one extreme or the other, overvalued relative to intrinsic value or undervalued relative to intrinsic value. And the consensus holds that. I mean, if the consensus didn't hold that view, the pendulum wouldn't get there, but it does because the consensus feels that way. We must diverge from the consensus. Our thinking has to be idiosyncratic. But because, as Dylan says, you see, everybody, as he says, everybody is subject to the same influences. We all read the same newspapers. We all hear the same things on TV. The economic news is the same for all of us, the corporate news, the market news. We all see the same inputs. It's all a matter of interpreting them differently. The same inputs, a bunch of inputs require the market to push to an extreme around which everybody coalesces. We see things differently. We think that that's not a rational decision. We think that's an error. We want to take advantage of it. So we do the opposite. And if everybody's bullish and thinks things are going higher, we sell. If everybody's bearish and thinks things are going lower at the extreme, we buy. But it has to be uncomfortable. Anybody who can do things, to bring it back to Seth, anybody who can do something that is that outside the norm and not be uncomfortable, there's something wrong with. I had somebody, I had one of my colleagues come to me around '98. Remember, long-term capital melted down. We had the Russian devaluation. We had the Southeast Asia crisis, et cetera. And this guy came to me. I think it was mostly about long-term. He says, "This is it. I think we're melting down. I think the world's falling apart." And I said, "Okay, I'm really glad you told me that. Now go back to your desk and do your job." I said, because a battlefield hero is not somebody who's unafraid. He's unafraid, but he does it anyway. And so it comes back to what Dylan said, constitution. Some people can overcome the influences to which everybody is subject, the coalescing of the consensus around the extreme position, which we contrarians think is error, and do it anyway and buy. My partner, Bruce Karsh, who runs our distressed debt funds, the pandemic episode was his fourth cycle. But I can tell you from the beginning, we've been partners 35 years, when the shit hits the fan and stock and debt prices are absolutely in free fall, he just wades in. And the cheaper they go, the more he buys. Now, the beauty is that debt investing, you can buy on the basis of yield. If you think it's going to go bankrupt, you're not going to get your yield. At least you have a creditor claim on the assets. So there is objective support for contrarian behavior. But I mean, he just has the fight or flight. For him, it's fight, and he just wades in, and that's what we have to do. But by definition, by definition, a tiny majority of people can take a position which is idiosyncratic and opposed to the consensus.
From the floor. First hands up. And
Thank you, Howard and Dylan. Thank you very much for great presentations. And Howard, especially as a practitioner, thank you for all your insights over the years, and the memos you post are invaluable to us. One question, if I may, as a practitioner, we talked about the market mood, and obviously we're either in or teetering with a bear market at the moment, depending what index you look at. How far along in the pendulum do you feel we are, and what signpost are you looking for to assess that kind of peak despondency? Thank you.
no pressure.
I'm pleased to have done the books and the memos over the years. I'm glad to have shared what I can. I want to mention that I found my discussions with Patrick, which you saw the video, so interesting and stimulating, and it brought up ideas that I will have a memo out tomorrow based on those. I'm gonna put out a transcript of that discussion next month. But tomorrow I'm gonna have a memo out called Bull Market Rhymes on the themes that we've seen in action over the last 2 years and how psychology does tend to rhyme, as Mark Twain or Theodore Reich said. How far along are we? After the global financial crisis, for many years, I received the question, what inning are we in? Which of course is well, I guess it's in cricket too, but in baseball. And in baseball, there are 9 innings in a regular game. And so people want to know, are we in the first inning, the beginning of the crisis, the middle innings, the normal progression, or the late innings? And the problem is that in the game of investing, or in a bear or bull market, there is no regular number of innings. So I can't tell you. What I would say is that there has been significant declines, enormous in the tech leaders. The memo will report on 50 stocks that are down on average 50% of the well-known names. I think that I'm not saying it's going to go further, but if the mood makes it go further, it has considerably further to go. I also don't think that a bear market is 20%. I reject that definition. A bear market is a state of mind. I liked the world better before we had these numerical definitions of a bull and a bear market, which is plus 20 or minus 20. And I just think that if people remain pessimistic, and if we get further bad news on inflation or Ukraine and China, Taiwan, et cetera, I think it has further to go if it goes, but that's not a prediction. I just don't think there's any reason to say it can't go down further.
Thanks everyone for some great insight. So I want to focus particularly on something Dylan said, but I'd love to hear everyone's opinions. So I come from a background of data science applied to elite sports performance. And you mentioned something about getting the edge, about having a new strategy where you could outperform your fellow investors, people you're competing with, and that resonated somewhat with me. I'd like you to elaborate a bit more on that, and also be in mind that it's not the case of just doing something different. You actually have to do something better. So whether it's the case of trying to do something different, try it out, but also to analyze what has previously happened to try and create a better strategy. Finally, to have that in relation to what is perhaps a changing market as well.
If you like, I think, yeah. So the process I was explaining was just a fundamentally evolutionary one. It's a learning process, and this is what I was kind of getting at with the notion of the market and the economy as a learning organism, a learning information process. And I think the mechanism by which that happens is the mechanism that you see across. I mean, what we're talking about is what I'm talking about when I talk about alpha decay, and what you're talking about when you see elite athletes lose their edge. is the overall ecosystem has wised up to whatever it was you were doing. The ecosystem's now learned it. It's got it. So you now have to do something else. Richard Dawkins talks about the canopy in the forest. And he says that essentially it's not really any different from a turf of grass on the ground. It just happens to be sitting on top of these trees, and the process by which that turf gets pushed up is the trees are competing with one another for light. So the net effect is really that they all get very, very elevated. They all get to a new place through this process of competition, and there's this kind of arms race effect. None of them gets a permanent advantage, and I think that's just exactly what you see in markets with different invest. And you can go as detailed and as niche as you like with this. It could be equity strategies. The value. Warren Buffett's very well known for his value investing strategy, and and even his value investing strategy, by the way, and Buffett is unarguably the greatest investor of all time, present company accepted, Howard, but he had long periods of underperformance, long periods of difficulty, long periods where he seemed to kind of lose the confidence of some of his investors, because the particular environment was just not conducive to that particular style of investing at that time. But then even within over time, that his value investing approach kind of worked. And then a funny thing happened after the technology bust in early 2000. Everyone. And by the way, during the technology bubble, the technology bubble of early 2000, late 90s, early 2000 was very, very similar to kind of like a much bigger version of what we've just seen, where basically the more stupid the idea was, the more the market liked it. And so Buffett was being very rational and very thoughtful and investing in cheap stuff, and it just kept going down. So obviously his performance looked bad, even though he was doing absolutely the right thing. It looked really, really bad. And what happened was when the technology bubble burst and suddenly Buffett's stuff and people who were following the similar strategy did very, very well, everyone suddenly became a value investor. And then the curious thing that happened was this. Suddenly the airports were filled with books about value investing. Right, airports. You could pick up a whole bookshelf full of value investing, and then something else happened. You had the birth of the ETF industry. So the ETF industry just allows you. You used to have to buy, if you wanted to exposure to a value investor, you had to give money to a value investor, and he would deploy the money for you. With ETFs, you could wrap a strategy kind of just into one security, and there was all these value investing securities. In other words, the market was now fully absorbed this idea that if you buy stuff that had a cheap multiple, you made lots of money. And guess what happened? For 10 years, none of these guys made any money, right? Again, this is a slightly simplistic example because it was more kind of complicated than that. But this notion that the market learns, that the environment learns, I think you see it in the economy as well. We were kind of talking earlier. There was a time when GM was the kind of greatest company in the world. General Motors was the greatest company in the world because automobile manufacturing was the growth industry. It's now, and I think Tesla's coming unstuck, but with Tesla excluded, it's a commoditized industry. It's a very dull, boring commodity. They're not great economics. Why? Because everyone's figured out how to do it. Right? There's no edge in making these things anymore. So I remember Alex Ferguson at Manchester United. He said that one of his principles of performance, whether it was in soccer, whether it was in sport, whether it was in politics, whether it was in finance, you were always looking for that as something that gave you, 0.5% of an edge. That's all you needed, 0.5% of an edge, and you would get kind of outsized kind of returns. So is that kind of process, which I said I see every day. I'm sure I experience it every day. How would you do the same? This is fundamentally how ecosystems behave, and so the market is really just an ecosystem. Your world, elite sport, is a competitive ecosystem, and again, from my mind, we're just completely not using the right tools to try and understand this.
I'm glad that Dylan started off that way. I'd like to add a few ideas, and then I'm sorry, but I have to go. the analogy to sport works very well. And, you know, I'm now in the 4th decade of writing my memos. And when I look back at the 3 previous decades, I see there is one discussing the analogy to sports in each decade. So and it's not intentional, but it's obviously a recurring theme. And so the comparison to sport is very useful, but which sports? And I would say, don't think of investing like shot put, which is a question of competing against a fixed standard, which is, you know, the tape measure. Think of it as a dynamic activity, like golf, where you're competing against other people, or maybe against basketball, where you are competing against other people, and there's physical contact. And so you have to take advantage of what they give you. You cannot, I guess in golf, your tactics can be absolute, but in basketball, you have to react to what they're doing. So I think that's very important. In investing, the goal is not to hit a certain number, it's to beat the other people. You're not a successful investor if you're not above average. You know, just having an 8% return is neither success or failure, because it depends on what other people are doing, which is to say what the market is doing. Golf is competitive against other people, or you could have as my English friends say, a rubbish round of 74 and be 1 up, or you can have a great round of 68 and be 1 down. That's very important to remember. The other thing is, and this is really important, think of investing like playing golf on a course that plays back at you. And this is what Dylan was saying about adapting. You go out, you have a great round. Everybody has a great round. Everybody shoots around 65 on a given day. They show up to play the next day. The course is completely different. It changed itself because it doesn't like the fact that everybody had high returns, or the high returns made the course tougher in some way. That's what happens with us. When everybody has a great year in 2020, they say, oh, what a wonderful year. Everybody made a lot of money. Guess what? You take that making a lot of money, you turn it over. What do you have? Everything got more expensive. Now the making of money made it harder to make money. This is the reflexivity. This is, you know, I don't know the depths of Soros's theory, but this is the reflexivity that I think about. The golf course plays back. Appreciation makes appreciation less likely. And by the way, and I'll just end with a plug, because I think the questioner used the expression thinking different and better. And that is the definition of, when I wrote my first book for Columbia University, the most important thing, they said to me, well, give us a sample chapter. And I sat down literally at the computer and I wrote something that it's kind of in the back of my mind, but I'd never written about before, which is what I call second level thinking, which is the consensus reflects first level thinking. To be better than the consensus, your thinking has to be different and better. The challenge is that it's easy to be different, but it's not as easy to be different and better. And if you're different and worse, then you're out of the business, but for long enough. But, you know, the first level thinker says, you know, Ford is bringing out a great new car. It's a wonderful thing. We should buy the stock. Second level thinker says, it's a great car, but it's not as great as everybody thinks it is. We should sell the stock. And this is all about departing from the consensus.